What kind of culture are businesses looking for in their banks, and particularly growing businesses looking for in their banks? What kind of culture are they looking for?
I think fundamentally more proactivity. I think, you know, the retrenching that I talked about earlier on has made banks very, very reactive. I think you know, the system-based process that they have in place also make them reactive. Talking on a no-names basis very recently to someone who where one of the major banks who's trialing a more proactive approach. It didn't come as a surprise to me, but it seemed to come as a surprise to them that actually they're finding a higher level of applications with a higher ticket value and a higher success rate in those applications, and that's trialing a more proactive approach. They're going out and talking to their customer base. Now, it's what businesses do day in, day out, isn't it? I mean, my members, you know, they are typically, Jason, those businesses, they're small, private, often family-owned, owner-manager businesses, employing people with fixed overheads. They have to pay the wages, they have to pay the rent and rates. You know, they go out and talk to their clients and innovate in new ways of servicing and gaining income.
So where's the middle ground? Is there a middle ground?
You know, I think fundamentally all businesses deserve service and deserve face-to-face contact. You know, if I'm an entrepreneur, I want some contact, I want some transparency, I want people that understand me and my business. So that's not asking an awful lot. And whether you're an SME customer or not, that is the expectation. I don't think that's unrealistic.
I mean, I think there's a level of, Huw, if you don't mind, a level of realism that perhaps needs to be brought to this debate. Because on the one hand, if you ask businesses, you know, and there are members of the panel here who do that regularly, we do surveys as well, what they want from their bank, they will say we want high degrees of service, we want access, we want good pricing, we want a great customer experience, all the things you talk about. Great. Really important factor, a lot of them say, is we want our bank to be with us through the cycle. So when times are bad, you're there, when times are good, you're also there. But let's be clear about what all of that means, okay? So our work that we've done shows that 40% of relationship managed clients don't cover their costs. They don't bring enough income in to cover their costs. The majority of banks, new entrants perhaps and challengers apart, are straddled there with a lot of fixed costs. They've got to pay for distribution, the cost of compliance now. So, and you have to apportion that appropriately. So things like know your customer costs, which are very important parts in business banking and commercial and corporate banking. The costs to do business now are rising. So this expectation that we will move to a model where, the Russian type model where people are out all the time doing face-to-face and with their clients, I'm not sure will work. I don't think the economics make sense. I don't think customers will pay for it in the round. And also, I'm not sure when you're talking about customers of a certain level, whether or not actually face-to-face is essential or needed.
We touched on relationship management and proactivity a lot of the time, and it seems to, often the debate moves into this face-to-face and how can that be afforded, and actually is face-to-face the actual linchpin of a relationship, or actually through maybe some innovation can we develop through the cycle that relationship so there's a longevity in it without necessarily having to have, dare I say it, that more expensive face-to-face? Because that's where it seems to be the break point.
But I think there's the disconnect here. I think that banks only want to build up an information set on their client so they can be assured that they're going to get their money back. And everything they've done, just to be cynical, is to build up an information set so they know the company isn't going to go bust, so they'll get their return back. Mm-hmm. And the company might see it as help. I'm not sure how much banks know, or a bank lending officer knows, about running innovative companies and how much advice they can give. They're trying to build up information in order to price the risk, in order to tell their boss that that company can pay their loan back. And so we seem to be in two different ways, from innovation to what banks are there to do.
But it's also the client who needs to understand what the services they can get from the bank. Yeah. And that's quite often also lacking. You know, the client doesn't understand the lending technologies in which they could choose from. Instead, they're just trying to get something, and there are many different lending technologies.
Phil, I'm really interested. Can I just make a quick point here? So, in terms of the culture, I've been in the industry now almost 30 years. When I first joined the industry, it wasn't so technology-led. So it was quite common for your bank manager in your community to be well-known and to look after your customers. And I genuinely don't think that is so much to ask for there to be a level of intimacy. Now, of course, people can choose channels that suit them. They might want the internet channel. They may use telephone banking as a complementary. But I think what we have seen is forced migration because of a cost set, which has progressively moved the customer away from a level of intimacy and understanding with their bank. And therefore, the share of wallet has diminished. And therefore they become unprofitable. It's a vicious cycle.
And also, I totally agree. And if we want to focus on what technology could do today, building upon that, today we have something we call big data. And with big data, we're opening up data silos. So at the moment, the data which banks are having about the clients is very little. Many of them don't even know if the client have another bank they're banking with. But with big data, you can get access to the client's innovation network. How does the data look there? How does the data look of the supplier networks? For example, if you want to grow Tech City, is that support having separate conversations with everything and a business, or is that actually to try to understand the whole nature of the way in which Tech City operate and then lift the whole region in itself? And that's where big data can come in and transform banking, where you're enhancing both relationship-based banking and the use of technology.
So Phil, if you had some of your members in the audience now, would they be confident in what they're hearing, or would they say, whoa, hang on?
Well, I think there's an interesting debate come out of that. I think, on the cultural issues, certainly that retrenching that I talked about as I think created a banking culture of same old, but with the addition of risk aversion. And that's a problem. I think it's a problem in banks innovating in areas where we're seeing new entrants and new platforms. So I'm talking particularly around peer-to-peer lending and things like that. The banks have the opportunity to scale all of those things, but don't seem to be interested. Just briefly touching on how that culture might affect, the pricing of risk. I think pricing of risk is already there. It's called mezzanine. It's called equity. If banks can't exist in that space, I mean, they will obviously buy some of their subsidiary businesses. But if there is to be an acceptance that debt finance isn't a mechanism for funding innovation, well, what the banks can do, I believe, in terms of improving the cultural environment, is work more closely with mezzanine and equity and angel financiers to support that process. So it's not just an equity deal. And it's not just a mezzanine deal, that there is debt that comes in as part of that portfolio of lending, which gives the business that better platform for growth.